Wow.
All right,
Hey,
fancy
wow.
new intro.
Uh-huh.
I like it. Good job on it.
Well done.
Hit that
honey.
again, DJ. One
That's
more
right.
time, like the record spin. Gentlemen, welcome, Ben, to the Resolve Happy Hour stage with the riffs. And, we like to think of this as an opportunity for us to enjoy a little bit of sort of a happy hour / water cooler conversation that whilst people are in lockdown, you may not be able to engage in some of these conversations. So it's a bit of fun, wide ranging as well. So everyone out there, be aware that if you're seeking actual advice, go get that from a professional in your jurisdiction. And
Call
with
Ben.
that said, cheers. I am having a Basil Hayden bourbon today. It's going
Okay,
down
say
like
that
razor
again.
blades. A Basil Hayden bourbon.
Okay.
It's going down like razor
what
blades.
is it? What's an apple basil and bourbon?
it's the brand name. Anyway, cheers, gentlemen.
Oh, I see. I gotcha. Okay.
Cheers, gentlemen, and welcome, Ben. I don't know if you grabbed yourself a beverage or
Rosé.
you're a sober guy or
Yeah,
whatever.
I drink. I have a Diet Pepsi in front of me. I didn't have any booze in my office, but I wait till my 3 young kids are in bed before I start drinking, I suppose.
Amen. A good plan always.
Prudent.
Yeah, you don't want to start getting aggressive too early.
I'm now
So
finding it's hard to drink around my microphone actually with the boom arm and stuff. I might have to drink with my left hand.
Yeah.
Oh, okay.
I actually I always drink with my left hand, but that's another story. One day we'll have that story. Well, hey, should we Ben, you want to introduce yourself? I'm sure you come with people are fairly familiar with yourself and your firm, but why not get it out there in the beginning and we'll get started.
Set the
Yeah.
stage.
I work for a firm called Ritholtz Wealth Management. We're a independent investment advisor firm based in New York, but roughly half of our employees work remotely. So I was the guinea pig. So I've been working there since 2015. I think there was 7. I was the 7th employee to join, and I was the first one to work remotely. And I got to know Josh Brown and Barry Ritholtz, who founded the firm, through the financial blogging space. It's kind of a weird thing that I ever got into it. I kind of started writing a blog called The Wealth of Common Sense, just on a whim. I just thought I have something to say. I'm sick of my friends and family asking me questions. I just want to answer questions for normal people like this. I've been working in the institutional space my whole career, nonprofits, pensions, endowments, foundations. And I was getting all these questions because people knew I was in the investment field. So I started writing about it. I had been writing for a couple of years and got to know them a little bit because I would go to New York City because I live in Michigan, would go to New York City, meet with investment managers that we worked with, and got to know Josh and Barry a little, realized we had some shared interests and principles and values and such, and ended up teaming up in 2015. I worked with them. They said, hey, move to Manhattan, and we had just had my first daughter. And that conversation never got off the ground with my wife. Now, if it would have been the Cayman Islands, like you guys, maybe that conversation would have gone a little further. But so working remotely, which has been nice for us through the pandemic. So we now have up to 30 plus employees at the firm, and half of us work remotely. And actually, I guess now everyone's working remotely, but half of us work in different places. So we have people in California and Florida and New Orleans and North Carolina and all over the country. And so we've always been a remote sort of paperless firm. So for us, this pandemic and the disruption has been relatively minor. And we have done most of our communication with prospects and clients like this, in a video call or a phone call or email. And so that's been a pretty seamless process for us. And I do a lot of writing about personal finance and the markets and what's going on and trying to help people, make decisions with their investments. And one of the reasons that I started writing in the first place is just to help myself process a lot of this stuff. And I never really was a writer before I got, in high school and college, I was never a big writer or reader. I think it just took finding the right subject matter. So once I got into the markets and investing, I realized this is really fascinating to me, and all the different wormholes you can go down from the behavioral side to the quantitative side and all these different things. I just sort of fell in love with it, and writing about it actually piqued my interest even more and got me more involved and more interested in the process. So that's kind of the deal with me.
When did you start?
It's funny
Ben?
how that works, right? The cross-domain type of experience where, I went through my degrees in psychology, and a big part of psychology is applied statistics. And I hated the applied statistics part of psych when I went through it in an academic program. And then I came out and spent a little time investing, did not use applied statistics at the beginning, did a lot of sort of global macro stuff, et cetera. And then decided, for lots of reasons, that I wanted to move into sort of the systematic space. And all of a sudden, all of those applied statistics lessons that I learned in university became very meaningful and very interesting and fun and engaging. And all of a sudden I wanted to write about some of the things that fell out of that domain. And so it's funny, you think you don't like something and then you realize it applies to something else that you really enjoy, and it takes on a whole new life.
Yeah, I went to a small liberal arts college, and I thought this stuff is such a waste of time for me. All these different areas that they made us focus on, and now I come back and think, it was actually making me more well-rounded, and it actually does help to have that wider base of knowledge. And most of the books now that I read, the ones I'm more interested in are those ones that are, vaguely about business and economics in the markets, but in a different way, and you can apply them to the stuff that you're doing in this space.
Speaking of books,
yeah,
you are out with a new book, right? What's it called and what's it about?
Yeah, this was kind of my pandemic play. It's called Everything You Need to Know About Saving for Retirement. And actually, I don't think it would have happened if it wasn't for the pandemic. When we got going in this thing, we said, all right, we're not going to have any face-to-face, in terms of our employees. Because I would go to New York a few times a year, and we have an office in Chicago. I could hop down there. So we started doing these video calls like this. And at first, it was kind of a see what happens and how it works. And now we're twice a week, all 30 plus employees are on one of these calls. And we had one early on, and we have a guy who runs our corporate retirement plan named Dan LaRosa. And we do these interviews where Josh Brown, our CEO, will ask every employee at the firm some questions. What are some pain points for you? What is something that the rest of your colleagues don't know about what you do? And he said, you guys all produce all this content in blogs and podcasts and books and such. He said, but I'm working with these everyday normal 401k retirement investors. And he's like, and they are just not going to read it. They just don't care about this stuff, or it's over their head. They don't want it. They don't want to know about the markets. They just want to know about the basic stuff. And I kind of stepped back and said, well, that's one of the reasons that I wanted to get into this. Is I wanted to help regular, normal people explain this stuff, understand it a little better. And I think that's probably something we take for granted being in this space, is that most people outside of it just aren't involved in it on a daily basis like we are. And you almost have to take a step back sometimes to realize, even people with, the nonprofit space I've worked in, a lot of these people who are on the boards and committees, they're not involved in this stuff on a daily basis. And you have to step back and realize how the storytelling you have to go through and the explanations you have to have and the expectations you have to set. It really makes sense, and not to assume people are as interested in it as you are or know as much as you do. So he said, I just need something that is just bare bones basics, help these people understand why it's important to save and can increase their savings over time. And so I said, all right, well, let's work on an outline. Me and him hashed out an outline after we talked about it. I came up with, 20 different topics, and he helped me. And I wrote this for basic people, outside of the finance world. My hope is people inside the finance world will know someone in their life where they'll say, you know what, my brother-in-law just doesn't know what he's doing. I want to give him this book to help him on his way. And it's really more of a personal finance book than an investing book. And it shows how, especially when you're just getting started, why saving is so much more important than investing. And I think investing is something that you can pick up along the way. And if you build those savings habits and really automate a lot of this process and get that stuff going, you can figure out the investing stuff later. I think if you can get that personal finance stuff going, and a lot of the stats I found, it's kind of shocking. So the Fed puts together all this data on how people are doing when they run some of their surveys, and they found, this is as of 2016, so maybe it's a little better now. Who knows? They found half of all people aged 55 to 61 have $21,000 saved for retirement. That's the median number, meaning half of the people in that age group have less than that saved for retirement. And it's not much better if you go down the age spectrum. It obviously gets worse. I think it's 40 or 50% of people 18 to 29 have $0 in savings. So we focus.
Negative. That's a positive.
Did you get any sense of the direction of that? Is that getting better? Is that getting worse when you looked at those stats?
Well, unfortunately for young people, and I think there are some explanations for this, but especially if you look at the millennials versus their parents, the baby boomers, it's something like 30% less wealth now at that age than their parents had. So if you look at someone like 30 to 35, and of course, a big reason for that is, more people now are going to school and putting off things like buying a house and getting married. So that's part of it, that people in the past were doing those things earlier and they were getting jobs earlier, not going to grad school. And so you hope that those young people are more educated and they'll make up for it down the line. But yeah, a lot of the numbers are unfortunately getting worse for people, and people are living longer these days too. So
right.
Maybe they have more time to play catch up. And I get into a little bit about that in the book, but unfortunately, a lot of people are they're just not in a good place when it comes to this. So they're reliant on things like Social Security or, as their only means of retirement for a lot of people in the States.
Or maybe it's all off book and cryptocurrency for the millennials. I have hope that they're richer than we give them credit for.
Well, yeah, and it's possible that, yeah, I think those are kind of retirement assets. So that's I think been a positive of this pandemic is that, you know, some people scoff at the way it's happening and that these young people are getting involved in things like Robinhood and trading stocks. But I think it's actually a pretty good thing that, you know, people were bored and nothing else to do and they decided to get into the markets. So obviously there's going to be some bad habits developed that way. And some people are going to, you know, lose all of that money. But the fact that people decided, okay, markets are down, I want to jump in with, you know, both feet here. I think that's actually a net positive for me.
Did you I think I read from you that you had your initial experience in the market wasn't great. Was that you? Like that was one, like a formative experience you had before you got into the business, or
that may have been Michael, who was my podcast co-host, who was more of a trader. I kind of have always started slow. I came out of school and I had all these friends getting amazing jobs and making a lot of money, and frankly, way more money than me. And I think part of that is my fault, because I came out and I was one of these people. I was never one of these kids who was reading Barron's and the Wall Street Journal in high school or middle school. I was more interested in sports, and, you know, I picked my college because I could play football there. I didn't look at the academics at all, which, you know, hopefully helped a little bit. And I probably partied too much in school, and maybe that helped me on my socializing aspects. But I went into my senior year of college realizing I have no idea what the hell I want to do in my life. And so I wasn't one of these, and I had all these friends who had, you know, I'm going to be an investment banker. And I didn't even know what these jobs were. I knew nothing about the markets. I couldn't have explained to you what a stock and bond were. I was way, way behind. And I luckily got an internship with an investment analyst at this place called Janney Montgomery Scott. I did a semester in Philadelphia, which is probably the best thing that happened to me. And these people, they just sat me down and were like, read the Wall Street Journal. And they like gave me the basics and started me and really kind of brought me along and realized, like, okay, I'm interested in numbers. I'm studying finance. I think this can help. So I was starting from a really low place. And I think that it kind of helped me because I realized I know absolutely nothing. And I'm sitting in these meetings and listening to these people, and everything they're saying is going over my head. And so I realized I had to learn. So I just started like this journey of like self-study and reading every book I could find. So every person in this firm that I talked to, it was all these different analysts covering different sectors. Every time I would sit down with one of them and they would have a little, you know, job for me because I was the low man on the totem pole, I would ask them, like, what are your 2 or 3 favorite books on investing? And I started compiling a list, and I just plowed over the next 2 or 3 years. I plowed through all these books, and that helped me just get this better sense of like being part of the conversation, understanding what people are talking about. Because to me, it was just such a foreign language, and so just getting started for me, I was so far behind the 8 ball that I had a lot of catching up to do. And actually, my wife, who was my then girlfriend, we had a long distance relationship where I'm working in the Detroit area, and she's still going to school after college to her grad program. And so I'm by myself in this city where I didn't know a lot of people, and I just used that as a time to really, you know, play catch up a little bit because I obviously didn't do it enough at school.
So you spent some time on the institutional side and then decided to focus on retail. One of the things we've been chatting about on the podcast and just in general is the fact that so many advisors and many high net worth or even sort of medium net worth private individuals tend to try to orient their investment strategy so that it looks sort of like what some big institutions do. Like they maybe model it after the Yale endowment or after, you know, big pension plans, et cetera. And we always find that to be so silly because these huge pension plans are so large that they are the market, and they have so many constraints on the type of investments they can make. And I'm just wondering, like, just coming from the institutional side, what lessons did you bring from the institutional side that are actually applicable to private wealth, and what ones did you realize later are just private wealth should ignore and do something completely different?
One of the reasons I came to the more private side, and I actually do work with a handful of smaller institutions. We have some nonprofits, but nothing like I was working with in the past. I actually butted heads with a lot of people in that space because I worked for an endowment. We probably were $1.5 billion, which a lot of people think is a lot of money, but in the foundation endowment pension world, that's not that much, right? In the overall grand scheme of things. And we had 3 of us that ran the investment office there. And that's actually a space where we had all these different conferences and in memberships that you could join, that it was like closed doors, endowments and foundation groups. And these people would lay it all on the line. It was like no media involved. It's like open book, everyone can talk. And so it was a very open and honest group about how things worked. And my big takeaway from that group is that how political it is, and you're dealing with committees and all these things. But one of the reasons that all the politics there made it so difficult to try to be like Yale. Not only did some of these places not have the resources and the expertise to do that, but they're trying to get these ideas past their boards and their committees, and they couldn't. So they're almost doing it halfway. And it's like, if you're not going to go all the way and, and have, do it the full way, what's the point? Then you're just taking the worst of this stuff, which is higher
measures.
fees. Yeah, exactly.
Yeah, half measures are the worst.
Exactly. And yeah, so I always thought, like, this doesn't make, if we're going to do this, let's do it. And if not, then we're just wasting money by paying some of these. And, again, the size we were at, even at 1.5 billion, we couldn't get a seat at the table with some of the best managers as it is. So we were getting the second and third helpings, basically, the leftovers. So I kind of butted heads with that industry a little bit, where I was telling a lot of them, even, 10 billion and under, I was kind of trying to tell them, this probably doesn't make sense. You guys should be probably in more liquid strategies. And if you're going to do it, maybe instead of trying to pick 10, 15, 20 of these private equity managers or hedge funds, just pick a couple of them, because trying to be diversified in that space just gives you horrible returns and you're paying a high cost. So I did butt heads a little bit in that space. So I one of the things I took away, is just, know your constraints as an investor, no matter what, because if you're trying to do something and you go halfway, it's especially in that space where there's so much competition, that's a tough place to be.
Or it's one of the things that we spend a lot of time on, actually, with especially high net worth clients, and especially people that come out of the where their wealth is derived from the sale of a business, right? They are comfortable in the business space. They're comfortable with private companies. They think that's where wealth is generated. And that transition from generating wealth, which typically comes, at least for more extreme wealth, from concentrated investment of time and money in a single business that you control and operate, right? So you come out of this framework where that's how wealth is built, and now you've got wealth from selling that business, and your intuition says you should use the same techniques to preserve that wealth, right? To achieve the other broader objectives that you have in your life. And we always struggle with, how do you sort of move a person from that wealth generating mindset to the wealth preservation or, sustainable wealth mindset. Do you have any insight on that?
Yeah, it's tough. We had a conversation a couple weeks ago with a guy who has spent his entire career at a really well-known publicly traded company. He was a high up executive there, and has spent his whole career helping build that business and got a lot of stock options there, but also used a lot of his money to invest in similar businesses. And when he came to us and said, okay, I realize I need some help here. I need some advice, and I don't just need investment advice. I need financial planning advice, and I need to know what happens now, because I'm reaching that next stage of my personal life where I want to make sure my family's okay. And trying to unwind a lot of these privately held companies he owns is a real problem. It's not easy, and you realize, like, if the first step is taking a look at, here's everything you own, here's your sort of asset mix, and you realize it's just this hodgepodge of different investments, and there's no really coherent strategy. And I don't think he ever realized that. He never put it all in one place and said, what am I doing here? Even though I have all this expertise. So yeah, it can be tough. And especially when you've made your money that way, the other side of it is a lot of people just, they don't want to lose. Sometimes they don't want to lose any of it because they've put their whole livelihood into it, and they don't want to let go of control and give someone else the steering wheel. So there is a lot of part psychologist in those conversations, and helping people understand, yes, you were working your butt off for 30 years building this company, but now you have to let go of the steering wheel a little bit.
Yeah. Isn't that the job of the wealth manager, the psychologist's job? I think it's 90% of the work.
For sure.
We understand what you do, what your fiduciary duty is, but then how to nudge people along. You talk a lot about savings rates, right? It's really tough to get anybody to save. And it's really tough, I found, to get, when I was in my wealth book, trying to get individuals to save without having some sort of trick attached to it, right?
Yeah.
I know, like, how do you think about the savings for the individual, how much they should save, and what type of behavioral tricks they can use in order to make sure that they can be successful at it?
Yeah, unfortunately, a lot of that is a psychological game. it's not as easy as just, knowing what to do and then going out and doing it. So in my book, I found these statistics in a book. It said between 1989 and 2012, Americans collectively spent like $1 trillion on weight loss solutions, exercise equipment. There was this huge boom. And what was the outcome of that? Obesity grew by 50% and severe obesity doubled. So we have all this, like the exercise boom really started off in the 60s and 70s and really kicked in the 80s, And so people are throwing all this money at it, and yet the outcome is people get less healthy, right? Because, it's a cliche to say personal finance is like exercising and eating right, but it's true, because if you just have the knowledge, that's not enough to change your behavior. So yeah, you have to do something. It's the same thing for building wealth. Everyone knows, well, I should, pay myself first and live below my means and all these things and save and invest for the future. But it's hard because people get overwhelmed, especially people who are outside of this business and don't know anything about it. And they don't know where to start. And they think that, well, if I just know how to pick stocks, then that's my investment plan. But that's way down the line in terms of things that are important for creating a sustainable financial plan. And you have to understand that it doesn't matter if you're the second coming of Warren Buffett. If you can't save some money first and put it aside, what's the point of having the world's greatest investment strategy if you don't have any money to invest? So yeah, I think you do have to trick people. And I think part of it is just starting small. So I talk about in the book about myself. When I came out of college, again, I kind of started slow and I wasn't making a lot of money at all. And after saving a little bit of money for an engagement ring for my future wife, and being on my own for the first time and paying some student loans and having a car payment for the first time in my life, I don't know, I had $50 a month to save, but I still did it. And I started it. And I think it was building those savings habits from a young age where I could see a little bit of slow progress, and it wasn't much. And I'd say, man, I'm getting nowhere here. But then my career progressed and I started making more. And then once I had those habits built already, I could save some more and save some more. And I think the biggest thing for me was learning just to have that stuff automated and pretend like saving money is a bill each month. So in my book, I talk about, pretend like it's a Netflix subscription or a gym membership, where those savings are part of your bills. So every month you have it automatically out of your paycheck. It's going into your retirement account or your online savings account or whatever it is, wherever your money's going, your brokerage account. It's taken out automatically, and you realize that I'm spending whatever's left over. So if you try to go in with the idea that I'm going to scrimp and save all month, and then whatever's left over, I'm going to save, like, we don't have enough willpower to handle that, because eventually you're just going to spend whatever's there. So the point is to get it out of the way first and put it on autopilot, and then spend whatever is left over, so you never even have to think about it.
If we take that to the corporate level too, I think what you want to see corporations doing is having the auto enroll, the auto escalate. You want to see relatively a good option for choices, but not too many, because you don't want the paradox of choice getting in the way of actually just starting to save. And then, maybe we'll talk a little bit later about, that transition from spender to, or from saver to spender, which is, I think, a big topic, but I don't want to jump there now. Was there, so you got the personal aspect of that, you've got a corporate, hopefully, aspect of that we can nudge corporations to do that type of thing. Was there anything else that was a psychological trick to engage in for
honestly, in terms of the studies that I found, that auto enroll stuff you mentioned was by far the biggest. So it's like the companies can help their employees automatically. So Vanguard has like a $1.3 trillion in their 401k system. And they looked at the companies that did automatic enroll, and then they have automatic escalation, which increases your savings over time, which I think is great too. So let's say you get a 2 or 3% raise each year. Say you save half of that raise or something, and you never see it hit your checking account in the first place, and it increases your saving. But they found that people who had automatic enroll for their employees had like 56% higher savings rates than people who didn't. And even for people who made less than $50,000 and were under the age of 35, their savings rates were double what people were who didn't have the automatic enroll. So just having that, making someone opt out and just making it easier, so people don't have to think about it, and it's just done for them. And they can have the ability to opt out, but it's people will take the path of least resistance.
Yeah, it's funny because when
they
I
have to opt out, not.
Yeah.
Sorry,
Yes.
Go ahead, Ron.
No, I was just saying that when I first got out of school and worked for the largest insurance company in Canada, I remember the discussion was how difficult it was to get enrolled. Like the inefficiencies, just the way they developed the software, the amount of choices that you had in the Manulife funds. it was a nightmare to get it going. And I thought it should be auto enroll, and it should be like, don't spend money and time trying to make it easier to opt in. Opt everybody in and keep the inefficiencies in place so that it's nearly impossible to opt out.
Yeah, and that's
right? Like, to invert the problem.
The other good thing a lot of companies are doing is they're making the default investment option. It used to be like the stable value fund, which now would be paying nothing because interest rates are on the floor. They've changed that to target date funds, which admittedly are not perfect in so many ways, but they're so much better than the alternative that most people would do, because it automatically gives you this fully diversified portfolio. So for someone who's just beginning and they're putting small amounts of money in, 50, 100, 200 bucks a month, whatever it is, the fact that they can in one fund be completely diversified, geographically across strategies between stocks and bonds without having to make those decisions themselves. And then maybe when they build up a little bit of a nest egg, they can go, okay, I realize this isn't a perfect strategy for me. Now I can diversify and learn this stuff a little more. But in terms of that, creating baby steps to just get going, that's been a huge win, that they're all making those the default option for people.
It's the equivalent of saving for a home, right? It's like the home is not a terrific investment. Well, historically, it hasn't been a terrific investment netted for inflation and operating costs. But just the habit of having to sock money away every year, it doesn't really matter that the investment itself is not particularly robust. It's just
it's forced savings.
It's forced savings, exactly. You're basically putting money into a bank account. The target date funds are imperfect too, but it's forced savings. You're putting money into a bank account, and over time, hopefully it'll pay off. One of the things that always bothered me when I was dealing with financial planning was that. And actually, this was a really interesting conversation. Mike, you may remember this. We had this conversation with, I think his name was Mike, who headed up the financial planning group at one of our previous firms. And he was a really thoughtful guy.
Right.
And he had incredible software, and he had really good ideas. And his ideas was that he wanted to present a super concise financial plan that acknowledged the ambiguity of, first of all, obviously market return trajectories, but also your life trajectory, right? Like included mortality assumptions, health, morbidity assumptions, how long you're likely to be able to healthily work and all that kind of stuff, and present this sort of concise plan that included all of these distributions, right? Acknowledging the probabilities and the uncertainties. And this is what he started out providing to advisors, and quickly the backlash from advisors came, which was, first of all, clients don't understand the role of probability or uncertainty along any of the dimensions that you're dealing with in your plan. And second of all, they're not receiving this type of plan from others that they're sort of shopping their portfolio around to. And so you including fifth percentile outcomes when the other advisor is providing a linear extrapolation of investment returns out for 50, 60 years and providing a 60 or 80 page booklet, we're just not able to compete. How does an advisor try to do the right thing and acknowledge the uncertainties along all these different dimensions when the client doesn't really understand the fact that this 60 or 80 page document that extrapolates cash flows out for 50 or 80 years is completely meaningless. And what actually matters is the uncertainty along with these different dimensions. How do you think about that problem and communicate about it with clients?
Yeah, I think when our advisors go through this stuff, and we have a lot of client-facing advisors who are doing this on a daily basis, I think it's helpful to show the clients how much of it can be garbage in, garbage out. Of if we change this one little piece here, look at how your probability of success goes from 70 to 80 or down from 70 to 6, whatever it is. So I think you have to be upfront with people that a lot of it is just guessing, because we don't know the path of returns, what they're going to be or what your life is going to be like. So I think a lot of it is really just not only helping people understand their goals, but clarifying them for them and helping them see what different decisions can mean for the potential. And then obviously a lot of the future is, it's planning, but it's also guessing too, right? A lot of it is guessing. And then, so the whole point of the plan is not like that first time in that 70 or 80 page document that you talk about. It's the process of it, and it's updating it as you go and having, these quarterly meetings or monthly meetings or yearly meetings, wherever it is, in updating and saying, what's changed, and then how would that change what you're trying to get out of this money. And so I think a part of it is just this fluent process that is ongoing constantly. And it's up to the advisor to tell the person that, we're setting expectations, but then we're showing you, as reality comes in line with those expectations, if things are better or worse. Now, here's what we need to do. And a lot of it is for people having, tough conversations sometimes, and especially with interest rates where they are, and telling people, either you're going to have to work longer, or you're going to have to spend less in retirement and change your standard of living, or you're not going to be able to accomplish everything you want to. Or, a lot of these things, some of it is setting expectations and having hard conversations with people who aren't as prepared as they think they are or should be. So,
even so I think what Adam's getting at is the use of the financial planning tool as a sales mechanism.
Okay.
And the implications that come with that, because if I go to one wealth manager or financial planner, he provides me a plan and says, hey, you're here, just do lots of equities, and check the box, you're there, only accounting for a 50 percentile outcome, versus a thoughtful advisor that says, no, you have to save more. Future returns are going to be lower because the bond component is at zero. Valuations might be here or there. And so we have to acknowledge the starting point. And so when you think, it makes it really hard for the thoughtful practitioner who's going to try to guide that conversation when financial planning tools are weaponized as vehicles for sales.
Ooh, I like that word, weaponized. That's totally, yes.
And so it's really hard because the end investor is not well equipped, as we've talked about on these concepts, even at a small institutional level, as you mentioned, is not well equipped. So how might we offer some insight on this conversation as to what investors might look for to try to guide their actions in sort of dissecting that or discerning, a really good financial plan from maybe a more sort of rosy but less meaningful.
Part of the way that we view this is almost I'm going to invert this a little bit. And part of it is working with the clients who aren't looking for something that you can't or won't give them. And so the way that we've done our whole process with building our business is trying to create a lot of trust by putting out our content. And so people come to us and they kind of know us already. And if they're coming to us and they're asking for something that we can't or won't provide, and they want you to hit grand slams and home runs, and they're looking for, I want 15% a year, and we're open and honest and telling them, that's okay that you want that. We don't think you can get that, but we're not going to try. So good luck somewhere else, and we try to help them along the way and things to look for. So I think part of it is looking for the right partners and clients right off the bat in terms of people that are looking for the right things. And we've said in the past to people, if they see our CEO, Josh Brown, on CNBC, we don't want them to come and say, hey, here's all my money, do whatever you want with it. We want to make sure that they understand our process and set our expectations and understand what we can and can't do for them and what we own and why we own it. So part of it is working with the right people and understanding, there's still going to be people that slip through the cracks and say, yeah, I got it, whatever. And there are going to be clients that down the line aren't going to work. But part of it for us as a business is working with the right people. So we're not constantly on the phone with these clients who are saying, what's going on now? Why is the market's down today? What now? And so it's getting those right relationships first to understand that you're not going to waste your time on these one or two clients who take up all your time and are just a big headache. And so we've had conversations with people who say, we're probably not the right fit for you. You're not the right fit for us. And here's the expectations that we're going to lay out. And we try to be open and honest and transparent about what we can do, what we can't do. And again, just talking about the fact that those financial planning documents that you said can be weaponized are used as part of the process, but they're not the be-all, end-all, obviously, because so much of it is constantly in flux and changing. So I think that's part of it, is just developing trust and working with the right clients to begin with.
Well, I think, it's self-selection is so key. And I think one of the wonderful things about the content marketing that you guys put out that we've also focused on is that you simply get people flooding in that are your people for the most part. There's going to be a few stragglers here and there, but it is a wonderful way of putting your personality, your values out there, and actually capturing the right individuals that are willing, like they're horses not being led to water, but they're in the water ready to drink. Right. Is 90% of the battle as you're building your wealth business, I think. So absolutely key.
So let me just go ahead. That's great. Let's dig into just a couple of maybe examples of things. If we look at a financial plan, so one of the things that when we're reviewing a financial plan as an example of something that I would point someone to look for is some sort of volatility assumption in the underlying investment assets, because of the difference between the geometric return and the arithmetic return and how those compound in wealth. So, if someone has a financial plan, I would want to see something that addressed that in some way. I think maybe if we all go around and think of that one thing that hey, listen, if you've got a financial plan, it should address that issue in some way. If it doesn't address that issue, then you should ask some questions. And maybe that's my example, but I'll throw that back to you guys just to think about an example that an individual advisor can be familiar with, and an individual and investor could maybe point to and ask the question of the advisor and hope to get a robust answer.
When it comes to that, I've always, we do our one-page financial plan, right? And that one page gives you a probability outcome. And the line that I use is a line that my mom used to use on me all the time. If you want to make God laugh, tell him your plans. And that appeals to every human that I've ever spoken to, right? We're like, this is a plan. What are the chances that this is the way it's going to turn out for you, right? This is the medium reality. Do you actually believe me or this page? Or are we going to have to iterate every year? You're going to get a bonus that you didn't expect. You're going to get an inheritance you didn't expect. You're going to lose your job. You're going to get sick. You're going to be healthier. You're going to live longer. All these things, a financial advisor, me, I can't do anything about that. All we can do and all we can help you with is give you a rough estimate, but know that every single throw that out the window. So whomever's coming with a 54-page plan with insane detail, that is, in our world, curve fitting, data mining, right? You're not going to get any value from those. You need to know that life has changed and we're going to be here for you as things go by. You wanted a rough estimate? Here's a one page. Let's not waste too much time on it. Roughly, you're in the right direction, and we're going to iterate every single year. That's I think
it's important. I agree. And I think it's important for people to realize that it's not just individuals who have these biases and make decisions suboptimally. I recall, Mike, you'll remember going to this presentation from Canada's largest community foundation. So it's a huge institutional foundation with, a large prominent board of directors and lots of internal processes and lots of internal staff. And I remember going to a presentation by the CIO and hearing how they had come to the realization that since their liabilities were inflation indexed, that their benchmark wasn't the market, but was rather a return, which was a function of their distribution rate plus their expected inflation rate, right? And so they went out with a new RFP that we're going to reshuffle the portfolio and we're going to do things a little differently. And they went out to 7 firms. How did they source the firms? Well, they went to their board members who were all senior partners at major investment institutions and asked them for referrals. And so they got these referrals that 7 or 8 different investment firms. And so they went out with RFPs to these investment firms. They said, what we want is a portfolio that will do 5% plus inflation for in perpetuity. And I forget what the number is. Maybe it was 7 or 8 or 10 or 11. I don't know. But anyways, all but one came back and said, I'm sorry, but in the current market environment, we can't present you with a portfolio that we feel has a high confidence of delivering on your investment objectives, which actually, from a silver lining standpoint, was pretty impressive, right? Yeah. You've got a bunch of profit motivated investment companies who came back and said, I'm going to turn down this revenue because I actually don't think I can meet your objectives as fiduciaries, which was great. They had one firm come back and say, yes, we think we can meet your objectives. Here's how we're going to do it. And what did they do? Instead of going back and reflecting on whether their RFP was reasonable, whether objectives were reasonable, they gave the mandate to the one firm that said that they could meet the objectives, right? So the lesson just being, there are actually a lot of really high quality, high integrity firms and advisory out there, but it's not just institutions or not just individuals that make bad decisions or are not equipped to make good decisions about which advisor to go with. Institutions make very similar bad choices.
Sure. So, one of the stories Barry Ritholtz always likes to tell is we had this person come to us, really wealthy person, $10+ million. And they said, all right, here's what I'm going to do. I'm going to pick you and 3 other advisors. And after a year, whoever has the best returns is going to get all my money. And so, and it's, you don't realize the crazy.
We get those calls every now and then too.
That you're running when you do that. And I think the other way to look at it too, to think about some conversations, talk about like tough conversations. There's also people who come to us who have already won the game. They have more than enough money they're ever going to need. So even though they can't make a ton of money in safer assets, it's like balancing this willingness, need, and ability to take risks. So some of these people, they made money by taking insane risks, but now you need to kind of talk them off the ledge and say, you know, you're going to be fine if you take, you know, less risk than you have now, and you just have some of your money in tax exempt bonds. And, you know, and so it's like pulling people back too. That's the other side of the equation, where you're not promising these people that you're going to make them into, you know, double and triple the money over the few years. You're talking about, let's take some of this and not mess it up. So a lot of people, it is that changing that mindset from I'm building wealth to now, I'm preserving it and I'm not going to mess it up at this point. And really, you're taking too much risk.
You know what's so interesting about that, Ben, too, and guys, remind me, I think it's from Moshe Malevsky's work, or I think that's where I remember this from, and it might have been Paul Samuelson, but they talked about your risk tolerance actually being relatively stable through time. That if you have a high risk tolerance, you have that through your entire life. And so here, and I forget the reference point there.
No, it's Samuelson, exactly.
Samuelson, right.
Because it's the volatility of wealth, not the volatility of incremental returns. Yeah.
Right. So here you have someone who has had an insatiable desire for risk throughout their entire life. They have all the money that they could possibly spend for generations, yet it will be entirely unsatisfying to give them a portfolio of T-bills. If we think about, you know, Samuelson's thoughts on this, and it's a really interesting sort of balance that, you know, an advisor, whoever in whatever capacity, is thrust into in that particular paradigm. And I don't know if you.
I had a client just like that, an executive in one of Canada's largest banks. He was a frontier executive that took over South America and made it work. And when he retired, we had a conversation. And I said, "Look, we need, you know, you're retired. You got your nest egg. Here's what we're going to do. Give him a relatively conservative portfolio." And he's like, "No. I want like the 30, 40 vol, 20% annualized rate of return opportunity." I'm like, what are you talking about? It took me 4 or 5 months not to talk him into it because I couldn't, but to understand where he was coming from. He had a pension that was paying him like 10 grand a month, right? He's like, that's all I need to live off of. I got this nest egg that now I want to have a shot at being like insanely wealthy. And I'm willing to go broke in that part of my life in order to try to achieve that. So his risk tolerance was as high as it ever was. I was never going to talk him out of it. And we just structured a portfolio for him that way. And sometimes you just have to give in.
It is interesting that this idea is that, you know, if you're on a pension, you've got to take the board. The board says, here's our desires. Please go get managers in this risk zone. When you're dealing with an individual as an individual advisor, you're sort of in the same position. It is to some degree their money, and we are trying to steward that or help guide them. But what are your thoughts there, Ben? Do you take the hard line on that and try and get them, you know, to take the less risk, or do you say, well, I've informed you at least of your opportunities. You're a big boy, capitum tour, and I'm happy to help. It's better that I guide you through this labyrinth than somebody else. What are your thoughts?
And one of the other release valves we'll do is we'll tell someone, take 5 or 10% of that money and we're going to put it into a brokerage account for you, and you can buy and sell crypto and penny stocks and go nuts. You know, so that's another, if you want to really scratch that itch, that can help people too. Some people just need to have that release and just get it out of their system. So that's another way that we think behaviorally, maybe that's suboptimal, but it can help them stick with the rest of their portfolio then fine.
I love that. We call that the cocktail portfolio.
Yeah,
because they got to have something to talk about at their cocktail party with their guys and gal friends that, you know, as a hobby or whatever the case may be.
Facebook, the Tesla.
Yeah. You know, I want to switch gears just a touch here, because there was an area of your book that I was really interested in learning more about, and I'm not sure that I'm aware, but the changing nature of retirement. So what did you learn there? Like the idea of retirement is a new concept. Is that the case, or have we had in previous generations, have there been forms of retirement? And then I don't know if you had an opportunity to look back and see through time, like, you know, 200 years ago, what did someone do when they wanted to retire, or was that even a thing? So just switch gears a little bit and dig into that for me, or for us, if you can.
I mean, the retirement plan of old used to be you died, right?
Right. You worked and died.
Yeah, some of the like I think it was like 30% of all males by the end of the 1800s lived past their 65th birthday. So when they first rolled out even Social Security in the 30s, they were assuming people were going to live 7 to 10 years maybe. And so back then, it just, I mean, if you have parents or grandparents who were involved in World War II, it was after that generation that people finally started having to think about it, because, it wasn't the case that, especially in the States, that everyone had a pension, but a lot more people did than do now. So it was a lot easier, and you didn't have to plan for quite as long. And people still want to have that mythical 65 age or whatever to retire, but now you're talking 2-3 decades that you have to have your money last for you in some cases. So it is a new, and I think that's one of the reasons it's so hard for people, because there's not very many good people you can look up to in terms of, hey, this person planned it out well, and they lived until 90 and their money didn't run out. So a lot of people just don't have good role models to look at in terms of retirement, because a lot of the personal finance habits are so bad with their parents or the people that their friends or whoever. So it is one of those things where you're really on your own. And even though we have 401k plans and such, in the United States, only 50% of companies have access to one. And so I think it's probably more like 30 to 40% of people are even taking part in them. So it's almost, my wish list would be that like the government would open it up to anyone who has a job, and this would maybe be another opt-out thing. Like, Australia has the forced retirement savings where they make their employer put a certain percentage in. Yeah, people would, go into that kicking and screaming here because freedom or whatever. But some people need that, where again, you'd have to do a nudge where you're opting out instead of being forced to save. But unfortunately, a lot of people just don't have access to retirement plans either, and it's hard for them to go through the process of opening up an account for themselves because they just don't know where to turn. So there's so many people that are just left out because they just don't know any better.
Yeah, and mathematically speaking, the idea of a defined benefit plan that is mandatory, that shares the retirement risk with the mortality table, is an insanely important part of a well-designed retirement plan. Having some amount of income, that if we think about Maslow's hierarchy of needs with respect to your financial planning and food and shelter, and having that shared risk, you're not having to plan for the 85th percentile because you could have bad luck in your investment returns, you could live really long, right? That you taking that one side of the risk off the table, and that to me is incredibly important, and it's something that's missed as corporations, because of tax rules, move to define contribution because they don't want that liability on their balance sheet. And so, I think individuals should really look at that as a significant benefit when they're interviewing employers.
Yeah.
If the employer has a defined benefit plan, that is a massive benefit to you.
Yeah, my brother works for the U.S. government, and that's one of the main reasons he's stayed in that job, because he knows at a certain age he's going to get a pension, and he's calculating the present value of that, and it's a pretty big number if you really think about it. That income, people don't realize it. They don't put it in those terms. If this would be the equivalent of X amount of money in a portfolio. And this is one of the reasons that I tell people in the States that Social Security is never going away, because that is the fallback for so many people. I think the number I found was like a quarter of people who are retired rely exclusively on Social Security, and 50% of the people have half their income come from when they're retired. So you're signing a death wish as a politician if you ever got rid of something like that. So it's actually been one of the more successful programs in history, probably, in terms of helping people, because all that stuff that came out of the Great Depression, there was no financial backstop for anyone back then, right? There was no unemployment insurance, there was no Social Security. You were on your own, and that's why that generation turned into the baby boomer, the frugal generation that really held things back. And that, it was funny, there was a lot of people at the beginning of this pandemic who said that's going to happen again. We're going to have this, this generation of people who really pull things back and they become more frugal and they save more because the pandemic really showed that we have a problem. And of course, the opposite has happened, where it's unleashed all the speculation and obviously, part of that is, I guess the lesson is never bet against the U.S. consumer. But back then, they didn't have the same backstop we have now, where the government could send out checks and the Fed could throw all this money in. So you didn't have that in the past, where people were really on their own, for better or worse.
Isn't it great to live in a risk-free environment? I mean, wow, it's every generation.
This is
before
what
us.
I was getting at. Like, so I don't know if you know, Ben, but I was born and raised in Peru, and I got to tell you, like, retirement has never been a thing that people discussed up until recently, when about 15, 20 years ago, the government started creating a superannuation fund where 8 to 10% of every employer's paycheck, employee's paycheck, has to go to the superannuation. One of 5 options. What's been interesting about this is that nobody that in my father's generation that I know of has ever stopped working. Like, retirement is not a thing they think about. They even lawyer friends of mine that I know have 2 or 3 side gigs, not because they necessarily need the money, but because they know that they're going to need to depend on that if something goes wrong in their careers.
Yeah.
You know, you got a soccer field where they put cameras on in the north of Peru. Another one's like making asparagus on the side. Everybody is constantly hustling. And what's happened recently, as we're getting to the first leg of people forced to retire and forced to use that superannuation money, they have the option of putting it into an annuity or taking the cash and a bit of a penalty. Everybody's taking the cash I know of,
Interesting.
and investing it in a business.
Wow.
But you bang your head, Mike. But I actually encourage
I get it.
when my clients are like, when should I retire? I'm like, never. You should never retire. I've seen people retire, and I've seen them like look 10 years older in 5 years.
I found some of my
You
research.
should continue to work. Life is hard. You should work and have a hard life until the day that you die, because it's fulfilling and it'll keep you going.
I kind of agree. There was some research that I found in this for my book that said people who retired early actually died earlier because
100%.
they don't have the same camaraderie of going into the office, or they don't have that same drive to do something. And I still have a ways to go. Obviously, now I'm just about to turn 40 this year, but I can't imagine giving up and never doing anything. I would go crazy, and my wife would kick me out of the house because she would go crazy because I feel like I need to do something. So I think that's one of the ways that this whole concept of retirement is changing for people. And I think that's something young people have already, readied themselves for. I tell them, the millennials, you're going to have Social Security, even if it's pushed back a little bit, but they say, I'm planning on not having it. And I'm planning on being my own. And I'm going to work until I'm 75 or whatever it is. And maybe that's the right mindset to have, that, and if things work out better than they planned, great, you're in a good position to do whatever you want. But I think a lot of people are in that mindset of, I'm just going to continue working because it does fulfill me and it helps a little bit.
I think it's
I do think we need to acknowledge the potential for that statistic to be correlation, but not causation, right? Like maybe people retire early because they don't feel well, or
could be.
They're morbidly obese.
I've seen it.
Well, that's the side of it. Is that
they start golfing.
Just relax. I'm not undermining your
the people who
ambitions for
The vitriol on the fact, Butler.
elderly entrepreneurship. I'm just saying, like,
I'm telling you, dude. I'm telling you, my father is still an entrepreneur. He works with other 75-year-old dudes that are coming up with ideas and small businesses here. They have the money for it, so they're funding it. They're getting younger people to help them run. This is like the last thing I want to do to my clients and my children and anybody that I talk to is not make them think that they can't make something to do with what they have and have this entrepreneurial ability, even when you have a full-time job, to have 1 or 2 things on the burner that may actually help you. In the moment that you say 65, we're going to get you there. Freedom 55, was that the thing
you triggered him, Butler?
Gringos had?
I know,
we may
right?
never
Freedom
get a chance
55
to
stuff?
speak again.
all of my
It's just
parents'
like
friends are
words
like, "Can you get me out of here? How can you get me out of this job that I'm doing?"
Of course, that's why you need
5 years before I.
Well,
Look
that's
at Ben. Ben found his passion, and look at him now.
But there's people who have that plan of, I'm going to work longer, and they might not be able to, because at that stage, you're one of the higher earners in the company. You could be forced to retire at an early age. Yeah. We've had to put provisions in our own company, because Barry Ritholtz, our namesake, he'll work until we drag him out of there, and so we almost have to put a thing on there. I mean, he's going to be coming to the office till he's 90 probably, but for some people that want to do that, you almost have to give them an out.
But
we
again,
have a name for that. It's their retirement party starts with clear.
Yeah.
Look, again, my point here is none of these elderly statesmen that my father hangs out with are getting jobs. Nobody's hiring them. They're making their own businesses. And if you don't have the experience of doing that and know how you can make it happen, the gumption to do it, if you haven't done it in your life, then you retire, you play golf, and you die. I'm trying to, get people to be self-sufficient, even if they like their job, because they might get pushed. Retirement is not an option.
I
ladies and
applaud
gentlemen.
the
It is not
effort, and
an
I
option.
think it's a virtuous position to take.
It's a wild experiment that developed countries have created that'll
I'm gonna
never
change
work.
the topic because Rodrigo's triggered, and we need to move on. So let's get it go somewhere else. So let's talk a little bit about that really important inflection point where you go from saver to spender. The portfolio goes into decumulation. What did you find there? Any really key points that you want to share, Ben, and your thoughts on that?
I didn't really get into that too much in this book. I have looked at this before, and I know you have all written in some of your books about that, the sequence of return risk, and that is one that I think every retiree we've talked to, for the past 10 years has said they just assume when I retire, there's going to be a bear market and I'm screwed, because you never want that bear market right when you retire and you try to pull the money out. There's obviously ways to protect against that, but I think that is one of the things that worries a lot of people, is that their timing is going to be horrible, and that it's Murphy's Law that the worst thing is going to happen at the worst possible time, and they're going to have bad luck. And unfortunately, as any investor, luck is such a huge element of this game. It's hard for people to admit it, especially when you're working with all these masters of the universe that are so smart, but just coming up during the right time and having the great returns. How many, I don't know, I don't want to take away from their track records, but how many hedge fund legends were crowned in the 80s and 90s because they started off with high interest rates and low valuations? And so much of it is timing luck. And obviously that's part of the reason why these big financial plans are not set in stone, because you're going to have to update and maybe make some course corrections along the way as reality hits, what your plans were. So I think part of it is not setting, everyone argues over this, what's the new withdrawal rate? Is it 4% or 3% or 1 point, whatever it is? I've never heard of anyone who actually uses that rule to take their money out. No one actually says, I'm going to take a specific percentage out and then I'm going to increase it by inflation. It's, when things are going really well, maybe you take out a little more, or you set aside a buffer, or when things are going really bad in the markets, then you stop taking it out. So I think you just have to have a backup plan in terms of, I'm not going to sell my riskiest assets at the worst possible moment, because selling when they're down is just going to compound the issue. So it's having enough safe assets to get you through those times, or maybe rebalance. So I think that's part of it, is just having some flexibility in your portfolio to see you through that stuff. Because, again, no one actually does it. So people argue over the 60-40 portfolio or the 4% rule, and I found no one actually uses those specific numbers. It's always unique kind of to someone's circumstances or plan.
That's a neat point, because I think that speaks to another reason why the moneyness of stocks has accelerated in the modern era. Because you can just think about the reflexive impact of most people thinking about their spending in the context of the current wealth that they observe in their portfolio, right? So when the wealth in the portfolio is up, their spending goes up. And so you've got this positive reflexive mechanism happening, because earnings, every dollar that's spent through the Kalecki equation flows through to the corporate balance sheet, right? So as long as people are feeling wealthier, and of course the Fed relies on this exact relationship in their job owning and driving asset prices up. But you can imagine people feel wealthy, they spend more, corporate earnings goes up, then you can justify higher stock prices, which means people feel wealthier, which means that their spending goes up. But the same principle happens in reverse, where if the market goes down, they typically will then adjust their spending lower, which means lower corporate earnings, which means lower prices, which means lower wealth, which means et cetera, right? So I always wonder, we struggled with this about 10 years ago, where if you just use sort of US benchmarks in order to guide your planning, then you'll make certain decisions. If you use global benchmarks, you use different decisions. If you use sort of more, what happens if returns during retirement fall in the bottom, 50 percentile of returns over any random 50-year period across all different markets. It turns out, especially if you start saving in later years, the return assumption, and especially in retirement, that return assumption makes a really, really big difference. And, I want to espouse simplicity, but I also want to acknowledge that there's actually a lot of randomness. Do you think about how to make portfolios more resilient, especially in retirement? and not be so reliant on sort of long-term average U.S. returns?
And one of the things we tell people now, it's like, if your portfolio isn't in a position now after the last 10 years where things have been going great, don't, the next 10 years, then if you're already behind, you've got a lot of work to do, right? Because you can't plan on the last 10 years happening again. So that's one of the things. And we're constantly updating our assumptions, especially, the stock market, who knows? Interest rates are what they are. Those are the anchor, and that's the easy one for people. That's where we're setting concrete expectations, saying, listen, we know what this is, so either we accept this or we move out on the risk curve. And you basically have no other option in terms of you have to accept some sort of risk, whatever it is. So that's part of the conversation. I did find, I wrote a chapter in here about, to your point about starting late. So I looked at the numbers and I found, let's say you start when you're 45 or 50 years old, you have nothing saved for retirement, and you compare two strategies. One where you save 10% of your money and you make a 12% return over 20 years. One where you save 20% of your money, but you only make a 6% return. If you did that using the same savings assumptions and the same income, you come out ahead by doubling your savings rate versus doubling your investment return. And obviously, doubling your investment return is much harder than doubling your savings rate. So especially for someone that late in the game that is really stuck behind the eight ball.
You have more control over it, certainly.
Yes, that's and that's kind of one of the things that we tell our clients all the time is, like, we're trying to focus on what we control. We don't control what the Fed does or the president does or tax rates, any of that stuff. We have to take that into account, obviously, but we can't control that. So we do have to focus on the stuff we can control, which is your spending, your savings rates, all this stuff. Where we locate your assets in terms of tax implications, all that kind of stuff, which is kind of boring to so many people, but that's the really important financial planning aspect of the investment process.
So what's so great about the increased savings that I think is sometimes either underappreciated or missed is, if you're saving 20%, you're living on $80,
Yes.
not $90, and lifestyle is sticky. When you drive a nice car, it's not fun to drive a shitty car. When you play at a private golf course, it's not fun to have to go to the public course. And so if you save that 20%, remember that your lifestyle, you're living on $80, not $90.
Yeah.
And thus when you
replacing
retire,
retirement, yeah.
correct. So now when you go into retirement, the income expectation isn't the $90, it's the $80.
You're used to driving the Toyota instead of the Lexus, and you're used to
Right.
playing at a medium golf course instead of the
Right. And the decisions that you make when we come to happiness is about being able to say yes to your friends. But generally, your happiness quotient is about being able to say yes to all the things that your circle of friends are doing. So that might alter your circle of friends slightly, but in the longer term, it's going to make you happier in the sense that you'll be able to participate in that. Your lifestyle stays steady. And so it's not horrible. It's just it's a really interesting side benefit to that. I think that gets kind of lost.
I had an attorney who came to me and he's like, okay, so I got $1 million saved, and I'm going to be forced to retire in 5 years. And I'm like, okay, great. How much do you spend a year? Well, my lifestyle is such, my wife has horses and whatnot. I spend $700,000 a year. And I said, well, here's what you're going to need to do. You need to get another job for the next 20 years. And you're going to need to cut your spending by 2/3 to be able to retire.
Did he have $14 million in his savings account?
Yeah.
No, but this is it, right? And it was, look, you're either going to have to cut your spending now, and have a thoughtful conversation with your wife and make decisions. Go live in South America, find a place that you think you might like. Think about that type of retirement, or it's going to be a cold bath for her when you get thrown out.
And I think there is hope for people who are later in life like that, because I have 3 young kids, and kids are obviously expensive. If you looked at the money on that, I don't even want to know what those numbers are. But hopefully, as you're later in life, that's when you can really supercharge your savings, because the kids are out of the house, hopefully done with college, and then you're, they're off your tab, hopefully. And I can understand actually why a lot of parents don't save enough. The whole idea is put your oxygen mask on first and save for yourself. But how many parents are going to say that when they're trying to save for their kid and not let them have as much college student loan debt or whatever? So I can get why a lot of people get behind on this stuff. It makes sense to me now that I have kids. I understand why you'd want to spend more money on your kids, but that's
and they're so grateful always.
Yeah, right. Yeah,
having 19 and 22-year-old kids and watching you guys have they're just so grateful for it.
But I think that's when hopefully when you can play catch up a little bit and take that money that you've been spending on your kids and paying for their college or whatever it is, and then put it into your and try to play catch up, because obviously there's a lot of people who need
Dude,
it.
they don't leave home until they're 30 now.
Right. Certainly.
One of the
I'm
things
with you.
that
It's
you,
a good idea. It's a good idea.
one of the things you recently wrote, like it was an eye opener, and I loved it. I'm gonna implement it. I'm gonna think about it deeply every single year, make sure I plan it right. And it's this idea of, yes, sometimes you need to spend today. You need to live today. We're young today, and one of the key things is that vacation with your family.
Yeah.
Right. You mentioned that you rented or bought a house.
Yeah,
and that to you is an expense that you see as a savings.
Yeah, I look at it
that.
as an investment in experiences, and I have 3-year-old twins and a 6-year-old daughter, and
Wow.
yeah, the 3 kids was never in the plan. The twins was kind of a surprise, but
Man plans, God laughs.
yeah, but we had a friend who a number of years ago said, they had kids the same age, and said, we have 15 or 16 summers left of them, hopefully, unless they stay till they're 30.
That's what got me.
And that really hit me, and so we could have taken this extra income and put it towards our savings and maybe retired a little earlier. But my wife and I had the conversation, like, what if we do this every summer and we go to the place on the lake, and we build memories there, and we've done it for the last 3 years. And I could have taken the opportunity cost of that and said, well, over a 15 or 20 year period, I'm missing out on X dollars based on this growth. But I never look at it like that, because we're building these memories. And so I want to have that balance. And I think for some people, it's the opposite, where I've always, for whatever reason, been a saver. I think it was just kind of passed down to me from my parents. They were always relatively frugal and took care of their money. And so I think that helped me a lot. So going the other way and breaking those savings habits and enjoying some of it today, and not just, saving it for some far off time in the future. I think that balance is really important. And for some people, it's the other way, where they spend too much and they need to balance the other way. But that's been something for me where I'll never look at that money as the opportunity cost of missed, market returns or whatever, because it's really money well spent for our family.
I want to make sure we get to some of the questions, right? Because Brian Moriarty has chimed in.
We can backtrack, that's for sure. So if you'd like to do that, we can. Why don't we? Brian, by the way, is going to be on next week.
Right.
So we could cover it next week as well, but let's hit it if you
Absolutely. Yeah. Well, also I'm trying to curry favor, since he's my dungeon master, and I want to make sure that he's. I'm just kidding. But yeah, he was asking about sequencing risk. We were talking about it earlier, and there's all these strategies about how to manage that transition from saving to retirement, and so I guess there's a bunch of studies, and actually one of my favorite studies was from Michael Kitces, which I think I read in like 2005 or 6 or something. And I think what essentially he did, although he didn't articulate it this way, but I've since gone back and sort of reframed it this way. But essentially he looked at he looked at it as the correlation between the returns in the first 5 years after retirement and your probability of success, or the first 15 years after retirement and your probability of success, and the probability as a function of the returns in your first 5 years, the correlation was about 0.8. And the correlation between returns in your for 15 years after retirement and probability of success was in the 99% range, right? But when you back it out, it ends up being really, what is the effective duration of your retirement liability? And so when I sort of backed it out that way, I realized that the effective duration of a typical male, sort of looking at the male mortality tables for US, of a male distribution liability in retirement is about 14, 15, 16 years, right? And so it really does the volatility or the dispersion or the risk in your portfolio returns in the first 5 years to 15 years after retirement has this massively disproportionate impact on the sustainability of your retirement income. And so I don't think that that's properly accounted for in many retirement plans. I don't think you have to go quite as extreme as what Brian articulated there. I don't think he's sort of advocating for it. He sort of just said this was studied. But I do think you have to give some thought to how you manage that risk and manage the effective duration of your retirement assets, and just how sensitive it is to early returns.
What do you think about a cash wedge there, something like that?
But hold up. Sure. I think what people miss here is that we're assuming that inflation is going to remain steady during your first 5 years. And if you were an American in the mid 70s, in 5 years, your purchasing power got cut in half. So what about the volatility of inflation?
Yeah, no, really good point.
So there really isn't any other way, but you're constantly balancing out risks. And I'm just tired of people not seeing the inflation risk just because we haven't had it in 30 years.
Yep.
I do like that idea of the looking at your allocation in terms of spending. So Brian talked about here 2 years of spending. I've had some people email me and tell me they keep 4 years of spending. Again, whatever, however you can manage that. But if you look at it in terms of like a portfolio, let's say you have 30% of your portfolio in cash or bonds or something safe like that. If you tried to break that out into how many years of spending is that going to get me, I think that's a form of mental accounting, but that's another way of thinking through this of, okay, this is what I'm going to go through first before I touch anything else riskier. Something like that where you consider some sort of a safe asset as your fallback plan and figure out how much to you is safe enough to get you through however long a bear market could last.
Little risk.
But again,
that's the cash wedge that Mike was describing.
Okay.
But
Exactly.
again, I want to emphasize that we keep on calling this a safe asset when it may not be your if you have $20,000 worth of spending and inflation doubles, and it has in the US, it has in every other country on the planet, you all of a sudden, your $20,000 only buys you half as much. Right. So again, I think the story that I had when my grandfather was an accountant in Peru, had saved a bunch of money. He had $1 million worth equivalent in Peruvian pesos, and in 6 months, inflation went to 7,000% and lost it all. Like his purchasing power went away in 6 months. Now that's a third world country. It could happen, but it is a real thing that if there was any time that a developed nation needs to think about that deeply and make sure that there's a right balance in their portfolio, it is now. And I think the idea of a cash wedge or being in mostly bonds and cash is a dangerous idea.
No, you're right. I mean, it's diversification, right? You're diversifying into a safe asset. And I think your point, which is extremely well taken, is that cash is only safe in certain environments, and it actually ends up being extremely dangerous in other environments. And just because we haven't seen those environments recently doesn't mean that they can't happen. And it's funny because it's been amazing. Just in the last 6 or 8 weeks, we've had a baker's dozen really large institutions reach out, and the conversations all focus on the fact that they're under allocated to an inflation basket, right? They're sort of identifying that there's this major embedded inflation risk in their portfolio, and they don't feel well equipped. And how do you guys discuss or think about an allocation to an inflation basket at Ritholtz?
Yeah, that's I think too. That's one of the ones that it's been so long since people have had to deal with that. That's pretty tough. I mean, I think the obvious answer, if you're thinking on the bond side, is that tips are the easiest way to think about hedging that. I think tips are one of the most unique assets that there is that probably not enough people talk about, just from the simplicity of it. A lot of people don't really like those because they still think of them as a treasury bond. But we also think about it, getting back to Mike's point about like saving more in lifestyle inflation. So if you build in a higher inflation rate into like your financial plan immediately, right, where you're talking about, okay, the current inflation rate has been 1% to 2% for a long time. What if we showed you an inflation rate for a financial plan where it's 4 or 5%? And how does that change the assumptions for something like that? So we look at it the opposite way of that. In terms of how would that impact your financial plan if your spending is increasing that much? So how
much more would you want to save in order to insure yourself against that type of risk?
And could your financial plan potentially handle that under some different assumptions? And if inflation got to those levels again, where they're much higher than they are today, and so that's one way to kind of stress test it from the financial planning side of things.
Do you think
it really
about
comes down to this.
Incorporating other structural assets that can perform in an sort of inflationary, whether it's inflationary growth, stagflationary, deflationary bust, or any other assets that you guys consider, or sleeves, if you will?
Besides tips, so something like gold is something that we have in certain strategies in our portfolio. So we think that can help in those situations. And of course, that was one of the better performing assets in the 70s when things get out of hand. And I don't think it even has to be the 70s for it to make an impact, because it's been so low now. I'm curious what investor reaction would be if it was just a little higher than now, even like 4%, which is not what it, not even double digits like it was in the 70s. What would the reaction be if it was 3-4%, which is whatever double it is now? I think that would be interesting to see how investors would react.
0% risk-free rate, that's a big spread.
For sure.
Yeah, 4 or 5% inflation with yield curve control holding treasuries at 1% would be a whole other type of risk that I think people haven't faced before, or not in the last.
Well, that's one of the things I found in the crazy World War II one, where maybe I think that could be the analogy here is you had this 1 to 2 year period where inflation jumped to 18% following the war from all the spending. And then it immediately went back down, it's crazy. So we had this 1 year jump where they basically got all the debt out of the system, and the government at that time held the rates low. So rates stayed low, inflation jumped like 17 or 18%, and then it came back down. And so you had this one period where you just had this huge loss of purchasing power. Then it came back in and things leveled out. I think that would be the interesting scenario too here, where we get this huge jump and people freak out about, okay, the 70s are back again. And then it comes down and that's probably a better case for the government than anyone else, because it, takes away some of the debt that they own on a real basis. But I thought that was an interesting period where rates didn't really follow the inflation in that time frame.
Yeah, if memory serves, was that was a bit about taking off price controls though, right? Wasn't it?
Right.
It was post World War II. There was a bunch of price controls. They removed those.
Yeah,
I'm going by memory.
Yeah, there was wage control. There was wage ceilings too that they took off.
Right.
That had part, and you obviously had the boom following the war.
Yeah.
But they controlled the interest rate, so because they had a massive debt as a government, right?
Right. Yeah.
So, that's where gold at the time you could buy. I think we have an index for gold miners during that period because gold was pegged, and the gold miners did really well during those scenarios. So there's always an exit, right? There's always some pressure somewhere where you can benefit from those scenarios.
Yeah.
We hope so.
Yeah.
Well, guys, what do you think? We're about an hour and 15. Ben, how are you for time, or what do we have we?
Is there anything that we haven't covered in your book?
It's been a great conversation. I'm still jealous of you guys for being in the Caymans and me being in the cold weather, but I appreciate you guys having me on.
You're welcome to join us down here the next time in the palm trees and whatnot. So no. Any last thoughts for your book on everything you ever needed to know?
What do you want investors to do? The 3 things that you want investors to do, or favorites to do.
Oh no, this is
He's got it. I'm sure he's got it.
No, but this is the book that I wanted investment professionals to give someone else in their life. So that's my only thing. Is hopefully this is a book that people will recommend to other people in their life that just need a little help and maybe just a kick in the pants to just get started.
Good Christmas gift.
Fantastic.
Yeah, it's a stocking stuffer, hopefully.
Yeah, I love it. Well, fantastic. Thanks for joining us. And next week we have the one and only Brian Moriarty from.
That's right.
Will be joining us too.
And he's your dungeon master.
He's so
can't
good.
Wait.
Yeah. Yep. Yeah, maybe we can even role play a session or two or something. I don't know.
Oh,
Are you guys going to come dress
a bunch of others
as your characters? I
That's
want to
right.
see some good backgrounds. I don't know if we can do that on.
We'll dress up and everything. Yeah.
All right, now I wonder. Hey, I wonder if we have some great outro music. Does Ani come on and give us some great outro music?
Ani,
now?
cue music.
Hit it while we sing.